Good evening and welcome to today's webinar on US Tax Framework, Key Insights for Startups and New Businesses. I'm Nikita Gulati, partner at Grant Thornton Bharat for US Tax Services. I'm a US CPA with 15 years of experience in US taxation. I specialize in US tax advisory. I actively support Indian companies in establishing their operations in the US, offering strategic guidance on tax and compliance issues. My area of expertise spans a range of industries, including manufacturing, telecommunications, consulting, and IT and ITS. My key areas of proficiency include US corporate tax compliance, US corporate tax advisory, transaction advisory, and compliance services for US entities, venture capital, and private equity funds as well. On today's webinar, we'll provide insights into federal and state tax requirements for starting a business in the US. It will also explore the tax implications of various business structures, available deductions and credits given in the US. United States is a significant market for foreign investment, attracting numerous global companies. To ensure long-term success, it is crucial to understand the key considerations for doing business in the US. Additionally, the webinar will cover important aspects of the recent US bill. Before we dive into various topics in today's webinar, I would like to share a view on doing business in the US and its territorial tax system. The United States stands as one of the most business-friendly nations, ranking 6th globally for ease of doing businesses, according to the World Bank 2020 study. Entrepreneurs can establish a business in as little as 4 days, benefiting from a strong legal framework, an open marketplace, and robust intellectual property protections. The country has also invested in nationwide business incubators that support innovation and commercialization. With a significant reduction in corporate tax rate from 35 to 21% under the Tax Cuts and Jobs Act and a proposed further cut to 15%, the US continues to attract businesses seeking a low regulatory burden and access to capital, making it an ideal destination for expansion and growth. On that note, I would like to share a little snippet on the territorial tax system. The United States operates a territorial tax system where taxes are levied and filed at multiple levels: federal, state, and local, each with its own regulatory authority. At the federal level, the Internal Revenue Service administers taxation, imposing progressive tax rates on individual income and a flat corporate tax rate. State taxation systems vary significantly. Some states follow a progressive tax structure, while others implement a flat tax rate. Additionally, a few states impose no individual income tax at all. Beyond state-level taxation, various local jurisdictions impose additional taxes: property taxes, franchise taxes on businesses. There are payroll taxes, of course, and sales and use taxes. Companies engaged in international trade must also comply with federal and import duties. Furthermore, businesses and professionals are subject to various licensing fees based on industry and location. This multi-tier tax system, while complex, allows different jurisdictions to generate revenue independently while aligning with the broader federal tax framework. On that note, to help you understand a better key insights on today's webinar, I welcome my colleague and a speaker, Shrenik Kotak. Shrenik is director with Grant Thornton Bharat based in Bangalore. He is an Indian chartered accountant and US CPA with over 13 years of experience, including 10 years in US taxation. He has extensive experience in corporate tax and partnership tax. He has rich experience in dealing in startup ecosystem and helps company end-to-end to meet the US tax compliance requirement and provide invaluable experience in advising them. He also works closely with US entities of many listed companies in India in the tax advisory, due diligence, and compliance bit. Welcome, Shrenik.
Thanks, Nikita, for the introduction. So, yeah, I think one of the key questions which I get when I am dealing with the startup ecosystem is that what is the right status or the entity structure which we should be selecting for the, startup in the US, and whether we should have the US parent, India parent, what structure. So, ideally, I recommend in that way that you need to kind of look at it, your requirement or the future requirement, I would say. So there is no an ideal answer for it but from our experience, we have seen the parent subsidiary model, which goes from the C corporation. So, I mean, in the screen which you see right now, you will find the most common tax structures which are used in the US, which is the sole proprietor, partnership, LLC, C Corp, S Corp, and the branch. So we'll discuss mainly about this six structures and what are the key differences from the tax perspective, how it matters to create which one, right? So the sole proprietors, similar like the India, it's a sole proprietorship, and the owner is supposed to file the tax return in the US for the incomes which are earned there. The partnership, LLC, and the S Corp, I would say. So LLC under also more of a partnership tax status, which we are selecting, has one thing which is common, which is there is a pass-through income which kind of passed on to the partners, and the partner has to pay the taxes. So the entity does not pay the taxes, but the partner pays the taxes. Unlike India, wherein the partnership pays the taxes, it is or in the reverse scenario, in the US, the partners pay the taxes. So ultimately, the onus is on the partners who has whatever income is being earned allocated to them, they have to pay the taxes. Whereas the C corporation and the branch works more of on a hand to hand, that the entity kind of pay the taxes on it, and whatever the distributions then after done from the C corporation or the branch are kind of considered as a distribution. So that is one of the key difference between the pass-through status and the corporation slash branch. I mean, you might get the status, but I mean, that what I should say, like, right? So LLC in the US can be treated as a partnership also, can be considered as a C Corp also, can be considered as S Corp also. So LLC, from our experience in the startup ecosystem, has been the one of the common structure which has been adopted, because it kind of allows the structure to be changed for the tax status. So what tax law states is that in case if LLC is incorporated by default by two members, then it's a by default a partnership. So if you want to now change it to S corporation, then you can just change the tax status without changing the legal entity to the S corporation by filing a required form. Similarly, if you want to do it to a C corporation, you can change it by filing another form. So LLC kind of allows a flexibility on that. Having said that, if any, from our experience, any of the startup who plans to have the US parent, we have generally seen that they kind of incorporate legal entity as a INC entity, which we call it as a corporation entity. So under that, you can only be a C corporation or an S corporation. The reason mainly is because that the investors generally would like to have a corporation as an entity and not the LLC, mainly from the legal perspective. So if you incorporate an INC entity as a C corporation, or whether you incorporate an LLC entity as a C corporation, it does not make as such any difference from the tax perspective. So all these are the legal considerations which is generally kind of come into the picture, whether you plan to raise a money, or whether, I mean, from our experience, if it's an India parent, US subsidiary, LLC generally works in a better way, what we have seen from our end. And branch is kind of the least preferred, I would say, which we have seen from our experience, considering the branch is a kind of an extension of the parent company, which might be in any other jurisdiction. And technically, it gives or kind of allows the IRS to question the contracts or anything which the parent company might are entering in the US or in any other jurisdiction, just to see whether that is being taxed or not. So ideally, the branch structure is something wherein that if you are planning to be temporary in the US, or you do not intend to have a major activities in the US, then the branch structure is generally preferred. Having said that, as such, there is from tax perspective, both C corporation and the branch are taxed at 21%, and the distributions done by both the entity structure are kind of taxed in the hands of the recipient. So there was a difference initially, but that has been removed, and ideally both are at par. Moving on to the tax rates, which kind of applicable to these structures. So the sole proprietorship, the pass-through entity, which we discussed, partnership, S corp, LLC treated as partnership, all these are taxed at the individual tax rate. So if you are owner of a partnership, then and whatever the income which you're earning basis on your slab rate which you're falling under, that will be taxed accordingly in the US. Whereas the corporation and the branch, as I mentioned, it taxed at 21%, and the withholding is to be done upon the distribution if you are paying it outside the US. And if it is paid within the US, then the owners of the corporation will have to pay the taxes as a dividend on them. So the tax rates are pretty much based on your personal income when it comes to the pass-through entity, whereas for the corporation, it's a 21%. Moving on, so the steps we have kind of kept it. So after selecting which entity kind of you want to incorporate, that there is a state of formation. So I mean, the Dharmesh, my colleague, will kind of speak about this in detail. But the state of formation, kind of generally from our experience, we have seen as a Delaware, which is more of a preferred state and more of a corporate friendly state. Many of the Fortune 500 companies are kind of incorporated in Delaware, which we have seen. But of course, there are other states who are kind of giving the similar incentive. And as Nikita mentioned, there are various state taxes which you need to be mindful about. But one thing which we would like to clear the myth is that if you are kind of incorporated in Delaware, does not mean that you are not required to pay the taxes in any other state. So, I mean, we'll discuss more in detail down the line, but the state of formation is more from a legal side, that in case if there is any legal case law or anything, then in the state of formation, those things are dealt with. So from our experience, Delaware has been one of the corporate friendly states which we have observed, and that is the reason many companies prefer that. So after that, choosing a name, filing the documents, and then obtaining an EIN, so which is the equivalent to the PAN number in India. There is an employer identification number which you need to obtain from the IRS. And then whatever elections which we discussed in the previous slide, that whether you want to do a partnership, whether you want to do a S Corp, C Corp, all those tax change status happens after this obtaining an EIN, and simultaneously you can start with your bank account process and everything. So this is the very basic process which you need to follow if you are planning to start a business in the US. Yeah. I mean, we have kind of highlighted few of the tax obligations which you will come across day in, day out once you start the business in the US. So it's a business license fee, normal income tax, the advance tax, kind of estimate tax, payroll taxes if you are hiring an employee, the sales and use tax, which is equivalent to GST in India, excise tax, gross receipt tax, and if you are planning to have a international related party transactions, then transfer pricing is also applicable to that. Unlike India, wherein you need to file Form 3CED and all that forms, there is no such requirement as such in the US to file any of the forms. Having said that, you need to have the benchmark study done, transfer pricing documentation, and everything which you need to maintain. And IRS has officially has mentioned in last a couple of years that their focus has been on this international transactions between the related party companies, and the transfer pricing has been the key. So if you are only maintaining the transfer pricing from the India perspective, may not suffice your requirement from the US perspective. So it is important that you maintain that. Another, if you are making any payments outside US, then the withholding tax obligations also you need to fill it up and make the required withholding payment to the IRS. There are states wherein you will do the business. They will ask you to file the annual reports, wherein they ask that who are your officers, what is your capital as on the particular date, everything more of that information those states will ask, which you need to be complied with. After that, I think moving on, we'll discuss about the due dates. So unlike India, wherein you have to follow April to March compulsorily, in the US, there is no such compulsion. You can follow any tax year which you want. And from our experience, India parent, US subsidiary, we have seen that April to March, they generally follow, considering the India consolidation and everything might be required. But having said that, on the screen, we have considered right now the due date or the calendar year you are following is a January to December. So your due dates will differ if you are following any other tax year. The key timelines, which is there for the corporate tax return, which is April 15. One of the another differential factor I would say from the India is that there is an extension which is possible for the tax return. So you have to file the extension with the IRS and the particular states with whom you are required to file the tax return. So you will file, hey, I want to the 6 month extension. There is no charges by the state for filing such extension, and there is no I would say scrutiny that if you have taken the extension that you will be under scrutiny that, hey, why did you take an extension? So extension is very pretty normal in the US, and you can get the 6 months extension easily. So 6 months is by default, which you will get it. So the revised due date will become the October 15 after that. So for other forms like 1099, 1042, irrespective of any tax year which you follow, you have to file it for Jan to December only. But for your normal income tax return, you can choose any of the tax year you may require, and the due dates will accordingly differ. Moving on, I think there are certain expenses which and the credits which are available in the US. I mean, I would say which you can take a benefit of or probably have to be mindful about while you are setting up the businesses in the US, and we will discuss about that. Starting from the organizational cost, if you can go to the next slide, please. Yeah. So organizational cost and a startup cost. So any cost which you incur to incorporate the entity or in and around the incorporation, those are kind of may not be deductible easily. I mean, in one go, and there are certain restrictions regarding that. There are dollar limitations as mentioned on the screen, and the expenses which are kind of will be considered under this limitation has also been defined in the section. Startup cost is different than the organizational cost. So I will give you the example. So say, for example, if you are starting a manufacturing business in the US, so you may have the entity in the US, but you are figuring out which state is preferable for the manufacturing, which location in the particular state, which machinery will be there, what will be the cost of the project and everything. So for example, it took 2 years after the incorporation to start the actual business which you are doing, right? So those 2 years kind of the cost which you will be incurring are considered as a startup cost and kind of are capitalizable under IRC section 195, and you need to take the treatment accordingly for that. So but the point here is that, I mean, many startup founders think that, hey, whatever I have incurred, I mean, until the start of the business, I will get the deduction for it immediately, and I'll be able to kind of set it off against once I start earning the income. So that may not be exactly the case, and the startup cost is kind of important section from that perspective. Moving on, the transaction cost. So this cost kind of is also come into the play, I think, once you kind of become a bit of a mature in the business in the US. Generally, I mean, this borrowing cost, reorganization, restructuring, changing the capital structure, if you are doing any acquisitions, anything. So from that perspective, this transaction cost becomes an important evaluation. IRC 263 in bracket A kind of deals with this, and they ask to kind of bifurcate the expenses into the facilitative and non-facilitative. I mean, in a layman language, facilitative is kind of what facilitates the transactions, and non-facilitative is what does not. So the facilitative cost, I mean, may not be deductible immediately. Some may be available for an amortization over a period of 15 years, and some may be just charged to an investment or to the stock capital, whatever you have raised. So purely what we are trying to conclude here is that any of such capital activity which is happening, this section kind of comes into the play, and IRS has been of lately very aggressive in terms of that, because they have found that the taxpayers are taking a deduction immediately for this. and they are not making the right treatments for under this section, which is required. So IRS has issued many guidelines around this also, that how that has to be treated. So this is an important section, and the cost if you are planning to do any such activity in the US, if you have already, entity up and going. Yeah. Moving on to the next slide, please. Yeah. So enough about what is allowed, what is disallowed. Let's talk about some of the benefits which are available. So R&D credit, ITCA, and work opportunity credit are, kind of popular credits which we have seen from our experience, clients which are claiming R&D credit. So any R&D activity which you are doing under IRC Section 41 that is allowed in the US, that they give the credit for doing the R&D activity uh, in the US. No foreign R&D credit is allowed for this. And software development also they have considered as the R&D activity, and we have seen many IT companies also claiming this. Having said that, it is very, very important that the R&D study is done properly, because whether first of all your activity qualifies for R&D, whether if yes, what expenses are qualify for the R&D credit, and thereafter you need to, if you have a multiple, if you are a part of a big group and if you have multiple entities in the US, then you have to look at the control group level, and then ultimately you have to claim the credit for it. So the IRS has also been kind of tapping this area from R&D credit perspective, and similarly for the investment tax credit. So investment tax credit also, like if you are making any investments in the prescribed area, which kind of a hot topic for the government. So they have given this investment tax credits benefits if you are doing in any such class of business or in the equipment property. So those kind of are available. Work opportunity credit is also something which is very, very kind of available for the business in terms of if you are hiring a targeted employee. So for example, if you are hiring a veteran or a disabled individual, or individual who has served time in the prison, so more of that targeted individuals, if you are doing that, then you can claim this work opportunity tax credit and reduce your payroll tax liabilities. Moving on. Yeah, so before I hand it over back to Nikita, so this is the last and one of the very important powerful incentive, I would say. Powerful incentive, I would say, to which is available in the US, and it is very, very much important that you can kind of evaluate if you plan to exit in the US down the line. So this is kind of available to the C corporation. Say, for example, if you have incorporated an entity with you and your spouse, and you kind of plan to do a business, and if you meet a certain conditions, have gross assets 50 million, and have the number business for the X number of years in the US, and kind of fall in the threshold. So technically, any capital gain which you will earn in the US, technically you will not be required to pay the taxes up to $10 million. So it is a per individual. So if you have you and your spouse, then technically the 20 million is the limit which you will get. And you can of course multiply it with the more number of members and everything, but that has to be structured from now, because the ownership criteria and everything has to be met, the number of years and that need to hold the shares and all those criteria. So this is, we have seen from our experience that many business owners are not aware about this, but this is one of the key benefit which you can plan it while starting the business itself, or if you have just recently started, then you can get this analysis done. So with this, I will hand it over to Nikita, and thank you for your time.
Thanks, Shanik. My 2 cents on what you just shared with us is that it's very easy to set up an entity in the US. It can be actually done overnight. However, for our audience, I really wanted to focus on a long-term perspective, understanding that creating a right structure, the right business entity is very crucial from the inception itself. Taking care of the different credits and expenses which are available, and not to forget there are certain benefits like QSBS, which one can look from a long-term perspective. On those areas, please feel free to write in the chat box any questions you have, and we are happy to answer those queries. But moving ahead, we have a very important topic to cover, which is essential policies to keep an eye on, which in the recent Trump's bill being introduced. And on that note, I welcome my colleague and another speaker, Shashank Jain. Shashank has over 11 years of experience, with 8 years of experience in US tax compliance, and has been actively involved in the preparation of US tax returns. He's managing US compliance matters for US entities. He's a qualified chartered accountant and specializes in US corporate tax compliances, tax advisory, and compliances for venture capital and private equity funds. And he even supports the HNI clients for the tax planning. He has provided services to various industries, including similar like mine, telecommunications, manufacturing, financial services, and IT and ITS. Let's hear from Shashank on the key developments. Over to you, Shashank.
Thanks, Nikita, for the quick introductions. And thanks, Frenik, for walking us through the US tax framework and the structures. Though these structures and framework is relevant how you want to do the business for, but it is important that what are the recent changes, and especially, what are the key focuses which a new business or a startup which has been already started the business maybe in last couple of years needs to keep an eye on. So the first one which we would like to talk about is the BABA policy or BABA Act separately. It's Build America and Buy America. Now, technically, this act has already been enacted a couple of years back or 3 years back. However, this is being in limelight in last couple of weeks, especially when Mr. Trump has taken over the government from 20th of January. Immediately, his actions tells that how well this act is very important. Now, having said that, okay, this act has been there in the books, but it seems like that Mr. Trump wants to enact this very soon and with a great motive immediately from day one. Now, what are the key features of the Build America and Buy America Act? Now, of course, he's focusing more on that. Even if you are manufacturing something in United States, the product, the raw material or anything which is being consumed should also be based out of United States. He's trying to reduce the consumption out of the United States, basically reducing the import, maybe the countries which are neighboring to the United States. Especially right now, what he's targeting with a lot of deportation and other things going on, the Canada and Mexico, typically the business model has been for so many years where the manufacturing is technically done in Mexico, where the cost and other things and labors is overall cheap. And then it's easy that you kind of transport and assemble in United States so as to sell the products in the market. Now he's trying to reduce that with this act, where he's trying to give that incentive to the manufacturers who are actually building in the America itself. He wants the product and the produce both has to be in America. Now, what are the key features here? Of course, you need to use the America-made materials. There has to be a certain percentage if you want to incentivize, then you need to use the products which are domestically being produced. Of course, his objective from this is to increase the employment opportunity, because currently there are a lot of cost of labors which is sitting in Mexico or Canada for that matter would be bringing to United States. Currently, he's also targeting the laws and the borders in terms of moving people freely around or not. Now, it's not just about the goods which is being manufactured in America or outside like Mexico or Canada, but also he's trying to focus that the labor is also not going to move freely. Now, of course, that's a lot of promises he has made, but that's something we are keeping an eye on, because he wants to increase the opportunity based in United States. Now, this will also strengthen not just the employment opportunity, etc., but it will also increase the robust supply chain, which is right now dependence on a lot of neighboring countries and nearby countries where the labor cost is very cheap, including Colombia and other states which we talk now, and which are currently in the news that he's trying to reduce that at a very fast speed. Now, the another strategy which we are right now talking about is that overall, he's looking into the act that, okay, if there are possibility that this act could be much implemented in a manner that the cost will move to the United States and it will be reduced from outside, imports will be reduced, etc. Along with this, he's also trying to, say that I will incentivize you with a certain tax rate. Currently, we are talked about it that the current corporate tax rate, which was long back, around 35% back in his administration, he has reduced it to just 21%. With an all straight tax rate, effectively the tax rate would come to a 25, 26% to do a business in United States. He's now trying that, at least the election promises he has made, that will made it to, the United States, which is roughly 15% to 20%, including the state tax rate. So there would be a drastic change. So looking at that, this overall benefit, he may not be completely going into that reduced rate for everybody, but for somebody who is going to apply this Baba Act, where the manufacturing people or the application on the manufacturing of and consumption of the goods, if it is happening for the America made goods, then those incentive will be given to those companies only and not to everyone. Now, what are the road clause? Of course. Now, since the entire supply chain, which is currently there outside United States, that is not going to be easy to completely move into United. So that is one of the roadblocks which we see. It's a regulation which is so much dependent on the external trade policy, world trade policies, and the overall geopolitical situation. So it's not easy whether he's going to do that. But that's something in last 10 days have been a discussion point as of we're talking right now. Maybe something can come tomorrow is something what we could look from this government. Now, of course, since America itself is a geography where the overall, the cost of making a material is itself high, the overall product of cost is expected to grow high. So that could be one of the roadblocks in implementing it completely. A lot of IPs today we see that it's sitting outside United States. Now his major concern overall from last 6, 7 years earlier in his administration also was that currently the IP is sitting the country where the corporate tax rate or the overall tax benefit is much higher. Countries like Ireland, keeping the IP outside, or India for that matter, where the IPs are outside. He tries to bring those things here, but that would be difficult, because moving the IP it's not easy. And of course, the overall production delay is possibly there. So we are keeping an eye on this policy where there are a lot of developments expecting in next couple of months or next 6 months once he's completely taking the charge. We are expecting that there will be something, a drastic change around the corporate tax rate, especially to incentivize Baba Act. Moving on to the next policy, there's another strategy which is commonly known as China plus one strategy or C+1 strategy. Now, this strategy is, of course, to mitigate the risk of depending so much on China. There are a lot of countries which has already been following up this, including India itself. As you can see that Apple productions or the MacBook productions has been moved from United States to various other, from the China to various other states. So US companies, Apple, they are taking help of other countries like us, where even though there are maybe the slightly higher cost involved, but at the same time, there's a less reliance on one country and dependency. So reducing that dependency and, overall geopolitical situation with China, it is that this policy is very much important, especially for the people who are into manufacturing. Not all the service industry are much following or rather adopting this, but this is more to incentivize the other government and the more dependency on the government, especially with China, where the issues are there from a geopolitical situations. Now, of course, that will be again the same situation where the labor cost and other things could go up if it is going to bound to other countries. However, the diversification is what the adoption is. Now, more and more along with the Baba policy, this C+1 strategy is also highly being promoted, including the earlier administration under Biden. And now also the Mr. Trump is also trying to focus on this strategy where it is not much dependent on China, so as to overall bring the efficiency and dependency on moving from one dependency to other markets as well. So moving on, this next slide, please. So this is the high level summary is there where we talked about the 15% tax rate. It's not gonna be applicable for overall companies. However, if President Trump applies this as per his election, then it will apply to the domestic manufacturing, or rather the consumption basis percentage will be there that this much percentage has to be consumed from the America made material. Now, what percentage and other things will come up, that will certainly the time tell us, but definitely that 15% charge will not be available to all the corporations. But somewhere, if we are talking about a 21% tax rate, now, recently, on day one after he took the charge, he has withdrawn the OECD, agreement that from the global minimum tax. Now, withdrawing that means that they are not going to follow what OECD and Pillar One, Pillar Two models are, which is there. Anyways, they have not adopted OECD Pillar Two model even in the earlier government. But whatever the was in the effect, he has withdrawn that with immediate effect, which means that if at all that situation comes up where it has to adopt or get to a percentage of 15%, that's what we are not expecting. Whatever we are hearing in the market, we are expecting that even if it has to go below 21%, it could range in the range of 18-19%, but not as low as 15% for all the corporation. Now, of course, he has also enacted a 10% across board tariff. That's again, a very important one there, because if the goods are being imported, he wants to leverage and make the cost equal if you are manufacturing in India with the applicability of BABA Act to bring down the overall cost the same, so that overall tariff he has made to certain products much aggressively, but on an average he has gone in ahead and added a 10% about tariff on all the US imports, especially as we talked about the China C+1 strategy. On Chinese goods, he has also trying that whatever you're importing from China, there's a 60% increase in overall tariff on that board. We talked about two geography, particularly Mexico and Canada. Right now, the free movement which is happening from the goods and also people as well as goods both, that is something he is completely against. Of course, the deportation and other policy which we are hearing a lot in this hour, but at the same time, it will be completely affecting Mexico, as I think President Trump has also funnily said that he has now recognized the Gulf of Mexico as Gulf of America. Something, of course, how world will react with to that. But of course, if at all he has to do this, and he has already implemented that, at least in America region, just to focus that whatever is coming from Mexico, that should shift to the neighboring states like Texas or the neighboring other states where he wants to promote the manufacturing based in America only. He wants to also look at the social security welfare. Now, this is not just from a corporate perspective. This is more from how he wants to incentivize the employees working in. He right now tends to eliminate what biggest today it is from a payroll perspective is the social security benefits. Seems hard to implement, but yes, this is what something he has kind of talked about. Now, also there's a proposal very unique about is that today, whatever the state taxes we are paying, which my colleague will talk about it, today, whatever the state taxes we are incurring, that you are allowed to deduct from your taxable income today. He's trying to reduce and maximum cap it to $10,000. There could be few states where a business is particularly being set up and there's a higher tax rate in a particular one state. Now, those state tax rate were earlier deductible completely, which reduces your tax cost by 21% of that amount today. That will be restricted now to $10,000. It's at again a proposed stage. The QBI policy, this for qualified business income specifically, earlier in his administration in 2017, he has implemented. There is a sunset window to that in 25. Unlike many laws like the bigger laws, which like guilty, beat, many acts which he has brought in, there are sunset window to certain laws, which is 2025, which is December 25. Now, since he has taken a charge, we are expecting that he is going to extend the QBI benefits. And the last one is, defending American job and investment tax. This again was there in the present. However, he's trying to bring that again and, bring some more leverage to bring more American based business. So overall, we seems that, if the acts upon and there are other departments which Mr. President Trump has opened, with all these things, we are looking at some aggressive stands which being taken. But of course, for the business, new business, and any startup which are already being there, there would be huge changes in the tax law in the next 6 months. So with this, thank you, and I'll hand over to Nikita. Thank you.
Thanks, Shashank. So rightly mentioned, Shashank, every new proposed bill brings in a new, some pros and cons along with it. And policies such as BABA, China Plus One strategy are trying to promote local sourcing and encouraging to diversify basically the supply chains what we have in order to mitigate risk and manage cost. By imposing the higher tariff on China and outside made products, it is trying to induce investors to manufacture, of course, a lot of products within US. The bill introduced by President Trump suggests a lot of changes such as higher tariff on China made goods, reduction in corporate tax rate, one of the most crucial proposed bill. All of us are just waiting to hear on that, and a removal of $10,000 cap on deduction of state taxes. So I request my audience, if you have any questions on these proposed policies, please write to us. If there's any question, you can use the chat window and we'll be more than happy to assist you on that. But to cover up the entire loop of US tax framework, we just spoke from a federal perspective a lot. I, on that note, welcome my colleague and another speaker, Dharmesh Desai, to cover an aspect from the state perspective. Before I hand it over to Dharmesh, I really want to share that Dharmesh is core area of specialization in US state and local tax compliance. He leads Grant Thornton's India's US tax compliance service group. Dharmesh joined the firm in 2020 with us and comes with over 13 years of dedicated experience in US state taxation. Dharmesh has helped several Indian companies again to set up subsidiaries in the US and have extensive knowledge in state income tax, sales and use tax, gross receipt tax, and annual reports registrations and compliances. On that note, I hand it over to Dharmesh for us to take it through the state taxation aspect.
Thank you, Nikita. So let's talk a bit about SALT now. SALT meaning state and local taxes. So when it comes to the US has a different methodology to tax you. There are around 50 states, and there are numerous cities and counties which in their own is a taxing jurisdiction. So basically, let's take an example. If you're doing business in the state in Manhattan area, you have to pay the Manhattan taxes, the metropolitan taxes. You'll have to pay the New York City taxes, and you'll have to pay the New York City state taxes as well. There can be as many as 400 taxing jurisdiction in one state. For example, Ohio, you will end up paying, if you're doing business, if you are meeting the nexus criteria, you will end up paying and filing in our almost 400 cities. So that is how vast the US ecology is. When it comes to setting up a business, we have to bifurcate based on the industry where you need to actually set up the business. So, for example, if you're a manufacturing unit, you will have to keeping certain things in mind, like the area, the geography of the location that you're looking at, the credits that are available. So, are there any investment related credits available, or job related credit available to you? If you are working on a distribution industry, then are there sufficient transportation options available, a port available to you? Are there any credits available to you with respect to port tax credits? These are certain things that you need to keep in mind when setting up a business. When it comes to service industry, generally most of the IT industry you would find in the state of California. Let's take for example, service industry is more reliant on the workforce, and hence you will need to set up a service industry where the workforce is available. This was true in the previous era, but after the post era, somewhat what trend we have seen is that most of the employees are working from home, and hence it has somewhere down the line become irrelevant. Most of our clients, we understand that the employees are either not present in US at all, or only marketing employees are present, and the major workforce may be working out of India, Mexico, and neighboring countries. So that is something to keep in mind to start with the service industry. You may end up having no employees or having just a marketing team in the US. When it comes to registrations, like Shrenik explained to you, Delaware is the most preferable state for incorporation. I would say almost 80 to 90% of our clients, we try to we incorporate them in the state of Delaware, but there are various other states as well. And it doesn't mean that if you're registered in one state or incorporated in one state, you're not required to register in the other state. So I'll just give you a brief. There are around 50 states, and out of which there are 43 states which taxes you on income taxes. Okay. And there are, it doesn't mean that the 7 other states do not tax you. The 7 other states may tax you in a different way. So, for example, Ohio will have a gross receipt tax. So it has a Ohio CAT, which is commercial activity tax. Washington will have its BNO tax, so business and occupation tax, something or the other. So they will try to tax you somehow or the other. So you need to be very, very careful where you start your business, because the tax rates can vary. New Jersey has the highest tax rate, about 11.5%, and there can be a state like North Carolina with a tax rate of 2%. Vis-a-vis, if you look at the states which do not have a income tax per se, for example, Washington, it does not have a income tax, but will have a straight tax on your gross receipt. So whatever sales you're doing in the state, you will be taxed at 0.7% or 1.7%, depending on the industry that you're working out of. So when it comes to registration, it will depend where you're doing business. So doing business can have a various definition. Mainly, if you consider uh, having an employee in the state, or having a property in the state, that constitutes to doing business. So wherever you end up doing business, you may be required to register. So there can be as many as 50 states where you have to register for yourself. And not just 50 states, there will be additional cities or local jurisdiction as well, where you may be required to register and file annual reports and pay taxes. So this is a vast taxation zone when it comes to filings. Compliance requirements can vary as well. So we'll speak a little bit of more on nexus. So nexus is nothing but a small connection that you may have with the state. Okay, the nexus can be. Can you go to the next slide, please? So nexus can be either physical nexus or an economic nexus. So basically, physical nexus will be having an employee, inventory in the state, or a property in the state, vis-a-vis having an economic revenue from the state may create an economic nexus. What has happened is, post the Wayfair judgment of 2018-19, most of the states have now moved on to the economic nexus, wherein just having sales in the state can constitute to doing business. And hence, there can be an increase in your income tax filings. There can be an increase in your sales and use tax filing as well. There are other nexus criteria as well, which you have not covered. We can speak about one, which is a marketplace facilitator. If you are in a distribution business, so wherever, let's say your distributor is Amazon. So wherever Amazon is registered or holds your property inventory, for example, you will create a nexus and will be required to file the return in those states. Moving back to the credits, if you can go to the previous slide, we'll speak a little bit about the taxes. Okay. So like we discussed, there are corporate taxes, there are gross receipt taxes, there are sales and use tax. Sales and use tax is a very vast topic, because the sales and use tax, general term is that tangible personal property is always taxable unless and until there's a specific exemption available, and services are non-taxable unless they are stated to be taxable. And each of this taxing jurisdiction may tax service or may not tax service. So so imagine a pre-written software which is delivered electronically can be taxed in 10 states and cannot be, and maybe in the other states it is exempt. So identifying your service and filing those taxes and be compliant with the sales and use tax regime is very difficult and very time consuming as well. Then there are excise taxes. So even if you're filing a corporate income tax return, there are 3 taxes which we come across. One is the corporate tax. Then there can be some franchise taxes as well, which are based on your net worth. And then there can be certain license fees as well. So this license fees also come into the picture. Then certainly, if you are doing a business in a state which has a high property tax, you will have to be careful in mind. If you hold property in those states, you will be required to pay those property taxes as well. So the taxation never ceases here. So even if there is no income tax in a state, you will end up paying some sort of the other taxes. And hence nexus is the most critical criteria over here. Now let's speak a bit about PL 8672. So when it comes to manufacturing industry, there are certain rules set up by the court. So basically, PL 86 nothing but public law, wherein an out-of-state seller shall not be taxed until and unless he has met certain criteria, or just a remote seller. A remote seller means a person who is just selling, or an entity which is just selling goods in a state should not be taxed unless and until they are doing some unprotected activity. Now, this unprotected activities can be there is a huge list of unprotected activities. So, for example, if you are just doing mere marketing in the state, and your employee is present in the state, he is doing marketing, and whatever orders he is taking, they are approved outside that state, then it is considered as solicitation and not losing the PL 86-272 protection. But if you are doing anything, so basically installation, or giving training in those states, or maybe having your own vehicle in that state, having an inventory, this all can be an unprotected activity, and you will be required to file a return. So you will be required to file a return, and you will be taxed in that state. So for manufacturing industry, we can very much plan in such a way that at least save on taxes or save on compliances in states where you are not required to do so. So that is certain advice that I always do give to my startups or manufacturing startups, that you need to keep this in mind. Because at the end of the day, you may end up filing in all 50 states, but if we can do some tax planning around it, we can save a lot on taxes as well as compliances as well. Moving on, let's speak a bit about credit now. So we spoke about federal level credits, but there are quite a few credits available at the state level as well. So mostly credits are available to entities which are doing manufacturing or any type of investment in the state. So it can be investment related credit, or it can be a job tax related credit. So for example, in each year, if you are able to increase your job by 50 or 100, you are allowed to take a certain allowed amount of credit. There can be economic targeted zones as well, wherein, for example, Georgia has a 3-tier model, wherein if you are doing business or increasing jobs in tier 1, you will allowed, you can claim a credit of $1,000. If you are doing increasing jobs in tier 2, the credit may increase to 1,500, and vis-a-vis, if you're doing a increase in job in tier 3, you can claim a credit of $2,000. So it depends where you are setting up the business, where you are doing the investment, and how many number of jobs are you doing. So, and also there are R&D credits available, energy credits available, and a lot of other credits available to do. And hence it is very important, keeping in mind US is such a vast country, you have to be well prepared before, in starting a business in the US. I think that's all from my side, Nikita.
Thanks, Dharmesh. So what you're conveying is that to set up a business in the US, and a state plays a very important role, because one needs to consider the type of industry from a state perspective, whether it's manufacturing or service, and what all credits and benefits one as an entity would avail from a state perspective, and how much could be the quantum of investment. That also plays a very important role. And last but not the least, the workforce required to run a business. All of these factors play a very crucial role in determining which state to operate in, and henceforth the tax filings and the tax compliances carry on from that point. Thank you, Dharmesh. Really appreciate your inputs. In the interest of time, I will be taking few questions from the audience, but we'll be able to manage, I think, 2 or 3. For rest, we will surely get back to you with a written response. You'll hear from the team itself. My first question is for Shenik. Shenik, one of the audience has asked that what is the most preferred business structure in the United States as per your experience? while dealing with different, startups and businesses in the US?
Yeah, so from the tax perspective, so generally we have seen that the entities like to keep the US business, India business separate. So they generally prefer a corporation, which more of a distinctive entity for the tax part, and kind of they don't want to expose the Indian entity or their parent entity in any other jurisdiction to the US. So the preferred tax status which we have seen is the corporation for that matter, because they would want to park the money in the US and they would want to reinvest the money in the US. They are not looking for the distribution or the withdrawal very frequently. So from our experience, the C corporation and basically the LLCs is something which is preferred.
And C Corp has a flat tax rate, just to mention,
Yes,
not
correct.
progressive
Correct.
tax rate. So that
Correct.
makes a lot of benefit for entities to look forward to incorporate as a C corporation.
Correct.
Thanks, Shubham. Thanks a lot. My next question is for Dharmesh, and this could be the last question because we are on time. Dharmesh, very quickly, one of the members is asking, can we conduct a business online and establish a nexus in any US state?
Yes, like we spoke about economic nexus. So even if you're doing a sales, a remote seller is selling goods or services in any other state and is gaining revenues from those state, you can create a nexus. Physical nexus is not mandatory as of now. And there can be quite a lot of different ways to create a nexus. There can be click-through nexus as well. So this is a very vast topic to speak about, but yeah, in general, there will be nexus created if you are doing business in the state.
Oh, that reflects a lot of tax compliances and tax filings, I believe then. So on that note, we have to end our webinar today. Thank you so much to the speakers and the audience joining us today. Really appreciate your support. And if you have any more further questions for us, please drop in the chat box. We will get back to you. And if there's anyone looking forward for any support from the US tax perspective, we as a group on the screen will be more than happy to assist you on that. Feel free to reach out to any one of us. Thank you so much. Have a good day ahead.
Thank you.
Thank you.
Thank you.
Thank you.